Hi, my name is Jeff Dragon, and I'm a financial advisor for North Shore Retirement. So how is Social Security taxed? It's a common question. Is Social Security even taxed? Oh, absolutely, for a lot of people, thousands of Americans. But wait a minute, how did they get your Social Security benefits anyway? Payroll taxes, right? So they took out 6.2% of your paycheck to fund Social Security. And then when they pay it back to you, they tax it again. Does that sound fair to you? Probably not, right? So how does Social Security even start? It was originated during the Roosevelt administration in the 30s. The president, Franklin Delano Roosevelt, even stacked the Supreme Court to make sure that it would go through the Supreme Court because he knew there would be challenges. There was a lot of hue and cry about how it was a communist plot, and then we were all going to have dog tags, and everybody's got a number now, and a lot of fear was spread around it. So it's an income stream that you can't outlive. All right. So the idea was to keep people out of poverty. So the New Deal, which was pioneered by Franklin Delano Roosevelt back in 1932, was supposed to create shovel-ready jobs. But the problem was that was easy to do, but the problem was the shovel-ready jobs couldn't be handled by people in their 60s. I mean, it wasn't like today. The seniors back then were smoking and drinking and having steak and eggs for breakfast, and they weren't doing diets and jazzercise and really trying to stay in shape back then. So the shovel-ready jobs were shovel-ready for the young people, but not really for the older folks. So there had to be some kind of safety net to, quote, keep American citizens from the poorhouse. That was actually part of the legislation that had said that. So originally payroll taxes were enacted it was called the Federal Insurance Contribution Act of 1939, or FICA as we know it now. They were much lower back then. They were 4% instead of the 6.2 that we have now. There's even current legislation right now saying that they should go to 7.4 to rescue the whole system, which they're saying, a lot of the experts are saying they could go bankrupt by 2035. The Social Security system has actually made money, been profitable, probably 3 or 4 out of the last 10 years, because when interest rates go down, the Treasury notes and Treasury bills that Social Security is invested in go up in value, and the system makes money, usually like 220 billion or so in gains. So that pushes out that 2035 year out further, which is a very good thing. Okay. So the taxes were changed when Franklin Delano Roosevelt said this was going to be created. It was said that the benefits paid out to citizens would never be taxed. The Reagan administration first started with some of the taxes for high earners, and then it was changed during the Clinton reign to make it so that there was more comprehensive about how people got taxed. If you go to my blog, it has a graph about how folks are taxed on it. Okay, but if your income is low enough, you're not going to pay taxes on your Social Security. But is that really something you want to shoot for? Having your income low enough not to pay Social Security taxes? If your income, married, filing jointly, is under $32,000, you don't pay anything. You don't report it. Therefore, you don't pay any taxes on it. But if your income is between $32,000 and $44,000, then you have to report 50% of your benefits. If it's over $44,000 in income a year from all sources, including tax-free municipal bonds, you have to report 85% of your Social Security benefits. You report all of it, but you're being taxed on the 85% of your Social Security benefits. So I'm going to tell you some ideas on how to minimize some of the taxes that you may have to pay on your Social Security benefits. And these are minimized. This is not tax evasion. It's sort of tax avoidance. It's just you're minimizing what you're paying on it. So these are legal. One way to do it is to build up assets or transfer assets into a Roth IRA. Philip Roth, a representative from Delaware, he even get reelected. Despite giving us this great savings vehicle, the Roth IRAs are tax-free forever. I say tax-free for now until Congress thinks of another way that they can potentially come after them. But if you build up assets in your Roth IRA, or if you transfer assets from an IRA into your Roth IRA, you pay taxes on whatever you transfer. Those assets are going to be tax-free, and will not be. You don't even report them. I mean, you don't even put them on your 1040, and it makes it so that you're reporting less income. So you would be, ergo, being taxed less on your Social Security benefits. Another thing you could do is you can potentially, before you take your Social Security benefits, use your IRA or your 401k or 403b, your current retirement plan, to maybe nickel and dime it or set it up so that it sends you an income, or before you take your benefits. So if you were to take your benefits, where you take your benefits at a later age, and you delay benefits till you're age 70, from your full retirement age to age 70, it actually grows 8% simple interest. So in order to get the simple interest upgrade, the increases on your Social Security, why not take withdrawals from your IRA and use that so you can live on those while you're waiting for your delayed credits. That's the 8%. Your delayed credits to build up. That's another way to do it. And then you just shut your IRA off in terms of income and have the Social Security benefits replace that income. And then just have to worry about require minimum distributions after that. Then your Social Security benefit is kind of your main source of income, with your IRA standing in the wings ready to help you. But in the meantime, you're deferring a lot of your income from your IRA and not using it. Another thing you could do is live someplace where your Social Security benefit is not taxed. There are 13 states that tax your benefit. 13 states that tax your benefit. And they are West Virginia, I've got my list here. West Virginia, Colorado, Vermont, Connecticut, Rhode Island, Utah, Kansas, Minnesota, North Dakota, New Mexico, Missouri, Montana, and Nebraska. Some states don't have any income tax at all, like Alaska, Nevada, Florida, South Dakota, Texas, Washington, Wyoming, New Hampshire, and Tennessee. They do tax, dividends and interest to a degree. I know New Hampshire does, but for the most part, there's no income tax, no federal income tax. No state income tax on those states. There's 37 states that absolutely do not tax your Social Security benefits, including my home state here, Massachusetts, what we lovingly refer to as Taxachusetts. They don't tax your Social Security benefits. So if you live in a place where there's no state tax on your benefits, well, you're ahead of the game, aren't you? The answer to that would be yes. Now, there's also a method, and this is absolutely legal, where you can use an annuities exclusion ratio to minimize your income. You can still get a great income, but the exclusion ratio on an annuity will allow you to actually, you're taking a portion of your principal and interest, and it can pay you a lifetime income. A lot of folks use this to basically, it's going to classify your income. It's going to knock your income down by almost 80%, your taxable income, that is. So you can still get a pretty good amount of income, but the taxes on that income is going to be lower. I'll give you a quick example. So if you're a 65-year-old guy, your life expectancy, according to the IRS and the census tables, is about 20 years, 85 years old, right? You invest $100,000 of taxable assets. It's got to be taxable assets. It cannot be an IRA. You cannot use an IRA for this. It doesn't work that well for that. So what you do is you take, if you divide 20 by 12, you get 240 months. We're going to do this monthly income style. If you divide the 100,000, your investment, by 240, it's going to give you how much you can get, basically. And it's about $417. It's really probably more like in the 500s or so, because there's going to be some interest that you're going to get. Otherwise, why do it, right? You're just getting your money back. The amount that wouldn't be taxable is looked at, as I said, as a return of principal. So if the figure is 500 or so, or maybe 600, there's going to be an exclusion ratio. So the actual payment, as I said, is going to be about $562 a month. So the taxable portion is 145, right? So that will be 417. All right, just stay with me on this. That'd be the 417 plus the 145. That equals 562. But the part you don't pay taxes on is the 417. So you're only reporting $145 a month. Okay, even though your check that you're getting is 562. So the exclusion ratio is to go over the algebra here a little bit. You're taking the $417 and dividing it into the 562, which gives you an exclusion ratio of 74%, which means 74% of that check is something you don't have to report. Okay, so that's going to do what? It's going to lower your income, is what it's going to do, your taxable income. So for the next 20 years, you're going to collect these checks, and you're going to get 562, but you're only going to report 145 as taxable income. That's going to lower your income, okay, hopefully under the $32,000, so that you pay zero in on Social Security, on your Social Security benefits. So why is this so great? Let's say your Social Security benefits are $2,000 a month, okay, and then you use the annuity exclusions ratio to give you another 562. Okay, so 562 times 12 is about, call it $7,000 or $8,000. So you're getting your $24,000 from Social Security, and you're getting your additional amount, as I said, the $7,000 or $8,000 from the annuity. But in reality, the annuity is only giving you 145 in taxable income. So what does that mean? So 145 times 12 is what? 1,300, 1,400? So your taxable income, okay, is the 1,400, which means that your Social Security income is going to be what? 24 plus 14 is under 32. So it kind of disappears. You don't have to report that 24. If you're under the 30, if from all of the sources it's under 32. So there's another idea that isn't new, but it is something that people have used, and it's called the QLAC, which is a qualified longevity annuity contract. This is different from the exclusion ratio. It results in you having a lower required minimum distribution. So if you've got a 65-year-old guy with 500 in his IRA, let's say they're in a 30% tax bracket, if they invest 125 in this QLAC, the Qualified Longevity Annuity Contract, which is legal in all states, it would give him about $37,000 at age 85, okay? But that means that at age 85, he's going to get paid that. It lowers his required minimum distribution on the 500, so that actually can lower his income because he doesn't have to take the money out of his IRA for the required minimum distribution. Now, we all have to pay. Now, if you don't pay your required minimum distribution, then there's a 50% excise tax, the IRS calls it, but it's effectively a fine. So the QLAC allows you to defer taking those required minimum distributions until a later date. And the later date is when you're 85. So it's all based on life expectancy. So if you're getting income, the other thing you can do, besides the QLAC and the exclusion ratio and the Roth, and a lot of folks will do this, you can donate a chunk of your assets. And it could be anything. It could be, you've got some income that you don't need, and you can always gift it to charity. These write-offs still exist. If you're getting interest income from stock dividends, bonds, real estate, you're going to have to report that. So if you change that income and defer it by selling those income-producing securities or property, and putting the money into a deferred annuity. If you put it into a deferred annuity, the money's still there and you can use it. However, it defers the income, so your income will go down, which makes it easier for you not to have to report income on your Social Security benefits. The other thing you can do, if you truly have, you're getting income from some assets, you don't need the income, you're just going to leave it to your family or a charity, then you can sell all those things and transfer the money into a life insurance policy. The life insurance policy, depending on your age and your health, could effectively double your gift to your family or to the charity, a cause that you feel passionate about. So how does that work? So if you've got $200,000 in stocks, bonds, mutual funds, securities, or if you own a triple decker in Lynn, Massachusetts that's worth $350,000, you can sell that. You can transfer the money into a life insurance policy. That's right, regular old garden variety life insurance policy. Because if you intend to leave that piece of property or those assets to your heirs, with a life insurance, they receive it no tax. There's no taxes on life insurance. It's tax-free. And you can be structured to use a trust to do this if you want to, and it's even the tax benefits are even better. So what you're doing is you're taking your $200,000 in stocks, bonds, and mutual funds, and you're transferring it into the life insurance. Your death benefit is usually going to be about double or right around there of what the amount of money that you're investing. So now you've doubled your legacy if you're leaving it to a charity or your heirs. You've actually doubled your legacy, and they're going to receive that tax-free within about 2 weeks after your demise, after you leave this earthly plane. After all, no one here gets out alive, right? And Jim Morrison said it best. So these are some ideas. If you're interested in learning more about some of these things, you can always go to my blog, and you can look this up, and it's all in writing there, so you can follow it a little bit better. But if you truly do need to maybe investigate yourself, how this would help you, how this could benefit you and your family, then please call me anytime. And maybe I can help. I can give you some information, and you can see if some of these ideas will actually work for you. Until then, so long, and thanks for tuning in.